Hey everyone, hope everyone's doing well and had a good day. This is the Emini end of day review for Wednesday, July 24th, 2024. Coming into the day, we will look at the daily chart first. And we know the market has been in this bull channel. We've had 3 pushes up, 1, 2, 3. And then up here, tight trading range, 3 pushes up here as well. So very tight trading range, breakout mode. And whenever the market's far above the moving average, like here, and we start going sideways, the bulls who were buying momentum, like here. Bulls are buying closes, we're getting lots of bull bars, and there's momentum to the upside. But as soon as the momentum starts to disappear, the market's in a trading range, the bulls take profits. When the market's high, they look to buy lower. But I kept saying we may not find buyers until the bottom of the last buy climax. So 1, 2, 3 buyers probably in this area. And then we had this bear breakout, which was strong enough for a second leg. And to me, the market looks like it's been in a trading range here since the 18th of June. And so coming into the day, we have a low 1 short after a strong bear breakout. 3 consecutive bars, trapped bulls, little overlap, good looking bars, closed below the moving average, and really disappointing if you're a bull and you were long up here. So in any pullback, bulls will look to exit their losing positions. Bears who didn't short will look to sell. We had a test of this breakout point yesterday. And so it looks like the market rallied, testing that breakout point, and bulls looking to exit, bears looking to short. The market tested it, reversed back down. And I thought there might be buyers below, but they may not come in until lower. So there's an increased risk. We get that second leg down and maybe test down here, which I do want to draw this level. 55.0275. I'm going to label that breakout point. Or rather, it's not breakout point, it's the bottom of the third buy climax. So I was expecting support in this area. So let me label that. I'm not sure why I can't label that, but we'll just remember that this is what we're looking at over here. And then just one more thing. Coming into the day, we had this really big gap down, and there's a lot of missing information here. So you don't know whether we had a lot of climactic, maybe high volatility trading range behavior in the Globex session, big up, big down, big up, big down, and we just happened to be low in a trading range here. We had a lot of trading range price action over the past 2 days. So I think it's worthwhile to take a look at the Globex session coming into the day, just so you're not oblivious to what has been going on. And here's what we have coming into the day. Trading range over here, bear breakout, follow through, and then it's a spike in channel, bear trend. Lots of bars below the moving average. The bulls have 2 closes above the moving average in all these bars, and this is a 15-minute chart. And so coming into the day, this looks more like a bear trend. The market is clearly bearish and not so clearly in a trading range. There's 2-sided trading through here, but the market is creating lower highs and lower lows, and that's a bear channel. So that's what we have coming into the day. And I'll just go ahead and flip back to the day only 5-minute, and we'll get started. So coming into the day, big gap down, the market's bearish. And then we have a bear bar closing near its low for bar 1. And so that means the market accepted the gap down. You can think about the gap as simply a breakout bar from the close of bar 81 to the open of today, just one big black bear bar. So huge breakout and then follow through on bar 1. That's good for the bears. We're so far below the moving average, it might be worth seeing what we get, because 80% of days have trading range opens. Only 20% of days are trend from the open bull trends or bear trends. And that's in line with the statistic where only 20% of days have bar 1 as the low or the high of the day. And so big gap down and bear bar accepting the gap down on the open. And there's an increased chance we go further to the downside because this breakout was strong enough for a second leg down. So bar 1, good bear bar, sellers above, maybe sellers below, but not that much information yet. We're so far below the moving average. Bears want to see really strong bearish price action if they're going to sell this far below the average price. And then follow through on bar 2. So consecutive bear bars, good for the bears. No stop order buy setup for the bulls. Probably sellers above bar 2 and sellers above 1 if we get there. Bar 2 is a smaller bar than bar 1, and there are some tails on the bottoms of these bars. So there might be buyers below bar 2, taking a chance, betting that this will be a trading range open because 80% of days are. So if you buy below bar 2, scale in lower, you'll be able to at least avoid a loss. But not a good buy signal bar on 2, so sellers above. 3 triggered the buy above 2, but then sold off into the close. So small bull bar, but lots of overlap with the prior bar. Triggered the buy, but failed to close above. Now there might be buyers below bar 3. The bears, they'll bet the bull reversal will fail. Huge gap down and then follow through. Bear bars on the open, and then just one small bull bar. The bulls have to do a lot more than this. And the market's always in short coming into the day, especially with bar 1 closing a bear bar. And there's nothing really for the bulls to buy. Because bar 3 is a bull bar, it's not a very good stop order signal bar, so there might be buyers below 3. But probably sellers above, betting that this bear breakout, 1 and 2, strong enough for a second leg down. And then we went outside down on bar 4. So if you're a bull and you bought above 3, betting it's a trading range open, get to the high of bar 1, and then you get bar 4, you're fairly disappointed. You got an outside down bar for your entry bar. And outside bars are trading range bars. They completely engulf the prior bar, in this case the prior 2 bars. And so there's a lot of overlap between bars 2 through 4. So it is true that there's trading range price action here on the open. But what else is true is the market's creating lower highs and lower lows. So this might be a bear channel. And so with only one bull bar on the open and the stop order bulls not making money, probably better to wait to see bulls start to make money before you start looking to buy. You'll frequently hear Al say in the trading room that he doesn't want to be the first, in this case, the first bull to make money. And what he's talking about is he wants to see the market move far enough, in this case, upward, far enough to the upside for stop order bulls to make money. But if you bought above bar 3, you immediately got trapped on bar 4. Also, with the first 4 bars of the day, so there's still not that much information, but with the first 4 bars, even limit order bulls are having a hard time making money. Maybe if you bought below bar 1, you could have made money as a limit order bull, but right now, always in short, easier to make money as a bear. And so in general, all that to say, bar 4 being an outside bar, in general, that's a trading range bar. It is an expanding triangle, but that's also breakout mode. And when you have a possible bear trend from the open, there's an increased risk if you're buying below bar 4, especially with not that much evidence of strong buying pressure, which in this case, we know what the Globex session looked like: spike and channel bear trend, just 2 bars closing above the moving average, and getting sold right away. And then on the open here, just 1 small bull bar. So probably better to wait for more buying pressure. Okay to be short. Bar 5 breaking out to the downside. So now we have an outside bar on 4 breaking out, and then follow through bar 5. Strong enough breakout, we're probably going at least a little bit lower. You can argue it's leg 2, breakout to 2, pull back, and then a new breakout down to 5. But this is tight enough that if you looked on a 15-minute chart, 30-minute chart, this would be a bear breakout. Also, the closes of the bars. I have every third bar labeled here, and that corresponds to the 15-minute chart. So we have a bear bar closing. If the 15-minute chart, if you're imagining the 15-minute chart on the 5-minute chart, here's the open, here's the close. You have a bear bar with a small tail above, small tail below, and then when the next bar opens and trades above bar 3, it did not get above the high of the 15-minute bar. And so right now we actually don't have a pullback on the 15-minute chart, even though we have a pullback on the 5-minute. And that's why we have a simple leg and a breakout on a higher time frame. So even though it looks like 2 legs down, it's tight enough that it could just be 1 leg on a higher time frame. We know it actually is a breakout on a higher time frame. And we'll probably get more to the downside. And still nothing to buy, and so bulls probably just stepping aside, waiting for more buying pressure, waiting to buy at lower prices. And for bears, it's always in short, okay to be short. You're getting a bear breakout and follow through. It's reasonable to sell bar 5. And then 6, there was more follow through. Outside bars can be considered, well, in general, most of the time they are trading range bars. And so maybe you see bar 5, or bar 4 rather, bar 4, the outside bar, part of this tight trading range. Then you have a breakout on 5 and then follow through on 6. So by the time you get bar 6, you now certainly have at least a bear breakout and 1 follow through bar. And again, think about the bull perspective here. Huge gap down, 1 small bull bar, tight channel. Whenever the market's in a tight channel, and this is in general because it happens in trading ranges, but in this case, whenever the market is in a tight channel like this for the bears, you only want to be looking to enter short. There's no reason to buy yet. And so you could sell the close of bar 6, betting that this is a strong enough breakout. We probably will not get above the high of bar 4, so stop above 4, sell the close here, and go for a measured move. Starting with the bodies, I like to start with the bodies. It's more conservative. And if the market gets there, you can then start looking at other measured moves, like this one down here takes you, that's using the tails of the breakout, that takes you to this price over here on the daily chart. 6 is a bad buy signal bar, even though it's a reversal bar. It looks like it closed above its midpoint, so technically a bull bar, but obviously tight bear channel, bad signal bar. There's probably more sellers above bar 6. 7 continued lower and even closed below bar 6. So now we have 4 consecutive bear bars and a tight breakout. So certainly always in short, no reason to buy. We're far below the moving average, but we are getting far above average bear price action. This is really bearish. We've had 1 bear bar, the bear bar, or 1 bull bar, and the bear bars are pretty solid. They're all closing near their lows except for bar 6. Because 6 pulled back and then 7's retesting, you may have some traders buying here And it's really just bears who sold the low tick of 6, disappointed by the pullback. And then they might buy back shorts when 7 trades below 6. But that's an example of minor disappointment. And disappointment's a word I use all the time. Obviously, I got that from Al Brooks. And I see a lot of things in trading as either major or minor, and that's even emotions like urgency and disappointment, confusion. In this case, there's urgency to the downside. If you're not short, you're watching the market just get lower and lower, and if you're not short, you're sitting on the sidelines, you're thinking, man, I got to get short, I got to sell a pullback. But if you didn't sell the pullback here, you're not getting a pullback. And at some point, you have to just sell. But some other traders will wait for the pullback and sell above a bear bar. So we might bounce here because of disappointed bears, but it's minor disappointment. So even if we do rally and bounce here, I suspect the reversal will be minor, especially considering what we've got. We might have a bear trend from the open today. And then we paused on 8, and that's probably due to the minor disappointment. Bears who sold the 6 low, scaled in higher, they're exiting here. But look at bar 8 and ask yourself if you want to buy above bar 8. And of course not. It's a tight bear channel. It's really a breakout on these past 4 or 5 bars. And then you have a doji signal bar. There's probably sellers above bar 8, scaling in higher. And to me, the market looks like it's in a bear trend. And then 9 didn't even trade above 8. And that's an example, again, of the urgency that we're getting here. Traders who want to sell a pullback are not getting a pullback, and they're forced to chase the market further and further to the downside. 9 may be a little climactic. It's a little bit bigger than the prior bars, 9 points compared to about 6. And then a couple of 8-point bars, a little climactic. We might pull back. Maybe it's 1, 2, pause, 3. Looks like we're racing to the measured move target using bodies. We might go a little lower before we pull back, but we might pull back soon. But the pullback is likely minor, even if it is 3 pushes, 1, pull back, 2, pause, 3. That's a parabolic wedge, and we know that parabolic wedges are breakouts on higher time frames. You can imagine this. Up to bar 9, we have 3 bars now closed on the 15-minute chart. I said bar 1 on the 15-minute opened here, closed here, small tail above and below. And then here's the second bar on the 15-minute chart, bars 4 through 6, small tail above, but pretty big bear body, closing near its low. And then the third bar opened near its high, closed near its low. So this is a pretty strong breakout on the 15-minute chart. And the odds are, even if we retrace 50% of this breakout, the odds are there would be sellers that would be somewhere around here. However, because of how strong the breakout is, deep pullbacks are sort of unlikely to happen when the market is this strong. When there's this much urgency and limit order bears who are trying to sell above bars aren't getting triggered, you have traders, like I said, they're forced to sell more shallow pullbacks. And so it's unlikely we'll get a deep pullback, like a 50% pullback, 70, 100% pullback. When the market's this tight, traders just want to get short. And this is a sell to close bear trend. Just sell for any reason. Stop above and look for a measured move to the downside. And then a pause bar on 10. So again, possible parabolic wedge. We might start to bounce here and go sideways, especially with this measured move target right here. But I do suspect it'll be minor, so I don't think it's a good idea to buy below bar 10, even though it's at possible support, the measured move target, and it's a trading range bar. I don't think that's enough reason. I think it's still always in short, and we haven't had a pullback. This is a micro channel from bar 4 to bar 10. So odds are sellers above 10, scaling in higher. And if you do that, you'll probably make money. 11 traded above 10, but sold off into the close. So it's a weak bull bar and could not close above bar 10, which was a trading range bar. So the market's going a little sideways here, but probably a bear flag. bear trend. Trading ranges within trends are flags, and there's an increased risk of a downside breakout. Probably 55 to 60% chance that any trading range breaks out to the downside, and only if the trading range gets to about 20 or more bars does the probability become more 50-50. Low 1 short below bar 11, not a good signal bar, and we're at a measured move target, so we might bounce a little, but again, I think it's reasonable when the market is this strong to just sell anywhere, even if you're selling a possible third push in a parabolic wedge. If you aren't short, I think it's important to get short and just put your stop above and go for a measured move. I think it's situations like this when there's urgency and it's hard to get short that Al kind of makes that analogy where it's like diving off the high dive in the pool, and it's scary, but if you just plug your nose and close your eyes and do it, everything ends up being okay. Probably sellers above bar 11, and there might be buyers below, betting it's a weak low 1, but when the market's this tight, strong breakout, low 1 short, probably not wise to buy below. 12, we went outside up. There were buyers below the low 1. We're getting a deeper pullback. And that's common. Low 1s typically do pull back deeper. Low 1s typically fail and then pull back deeper, and we get low 2s, low 3s. However, I still think it's probably more wise if I had to choose between selling below 11 and buying below 11. I understand the logic of buying below for a scalp, but I certainly would not buy below for a swing. But if you're buying here, you're taking a chance. You're trying to be the first limit order bull to make money. Also, think about bar 8. Bar 8 was a trading range bar. You had bulls buying below bar 8, taking a chance. Trading range bar, buyers below. They got trapped on 9. The market's retesting the low of bar 8. You can see the market tests it, sells off, tests it, sells off, tested it again. This is a 3-push pattern. That's a wedge bear flag. Outside up, 12. But the context here is much different than this outside bar. 12 is an outside up bar, but a third push up in a bear flag. There's probably sellers above 12. This is creating a low 2 short in a bear trend. And I said earlier, I don't know if I finished this thought, I'd rather sell below 11 than buy below 11, because if I sell below 11, use a wide stop, scale in, I'll probably make a lot more money than I could make buying below 11, even if in the short term you get a scalp. You can see 13, we traded above the outside bar on 12 and then reversed down, and 13 became a strong signal bar for the bears, low 2 short, bear reversal bar closing on its low. Also, bar 12 is the close of the first 60-minute bar. So if you look at the hourly chart, think about what the bar looks like. We opened here, we went up a little, and then closed all the way down here with a small tail below. So pretty bearish first bar of the day on the 60-minute. Low 2 in a bear trend, strong signal bar. Probably not wise to buy below, even though the market's been sideways for 4 bars. It's better to probably sell on a stop below 13. However, the stop does not go above 13. That would be an example of a skunk stop. If you sell below 13, the stop goes above bar 4. Now, you never intend for that stop to get run, and traders will get out before their stop gets run there. But you want to avoid putting it somewhere like above 13, where if the market trades above 13, the odds are there are sellers above 13, and you could easily get trapped out with a stop run and then a reversal back down. But in this case, 13, low 2, strong signal bar. To me, seems like probably more sellers below. The bulls don't have a lot of buying pressure, and it's still a tight bear channel. 14, we broke out to the downside, closed below 13, and we're going a little lower. Now, for the bulls, the argument is a double bottom with bars 10 and 14. And it is a double bottom, but your signal bar is bad. It's consecutive bear bars. And when the market's in a trend, 80% of reversal attempts fail. And reversal patterns, like double bottoms, this is what Al says, It's better to refer to reversal patterns in trends as continuation patterns because most of them fail. 80% of them fail. So if you see a double bottom in a bear trend, probably better to get short. And if we do trade above 14, there's probably sellers above. 15, we have an inside bar, still a double bottom, and a weak signal bar for the bulls. So when the market's in a bear trend, selling below 15 looks scary. We're in a tight trading range since bar 10. Doji signal bar, you don't want to sell below a trading range bar, low in an overall trading range. But the trading range is minor. And the reality is this is probably a pullback in a bear trend. And the pullback is mostly sideways. We didn't even get above bar 9. And so this is pretty strong for the bears. And if let's look at a measurement from the high of bar 1 to the low of bar 10. And we look at how deep this pullback was. And the levels I have shown are, 33%. Let's just make it 30 to be more simple. So here's 30 in red. So from here to here, this is a 30% pullback. We couldn't even pull back 30%. And that's what I was kind of mentioning earlier. When the market's this strong, you're not expecting a 50% pullback. In this case, we didn't even get 30% before we're getting continuation down. And so selling at the low of the day is actually reasonable and acceptable when the market's in a bear trend. One more thing, we came close to this measured move target on bar 10 and then paused, reversed up. And whenever the market comes close to a target like that, and especially when it's this strong, doesn't look like a reversal pattern, looks like a parabolic wedge, which is a breakout on a higher time frame. When it falls short of that pullback, of that measured move target, starts to pull back, the odds are we're going to get there in just a few bars. And then 16, we finally did get there. We fell below that measured move target, and we ended up reversing, but 16 is a weak signal bar for the bulls. The bulls will argue double bottom, lower low. However, this does not look like a credible major trend reversal setup. Where's the trend line break? There's no meaningful major trend line break here. The market's testing the trend line, but failing to really get far above it. And look at the buying pressure today. Just look at the bull bars. Bar 3, 11, 12, 16. Small bar. Here, doji. Close below its midpoint. Outside bar, immediately sold. The buying pressure is weak. Tight bear channel, only want to look to sell. So looks like a reversal setup, but small bar, small risk, low probability. Better to sell above 16. Probably a continuation pattern. Inside bar 17, couldn't even get above 16. Still reasonable to sell below 17, betting we're in a bear trend, so it's okay to sell at the low of the day. And this looks like a triangle. And maybe a bear flag. And it's descending, which is actually stronger. For the bear case, the pullback is almost sideways to down. The bulls have really nothing. If you're a bull and you bought above bar 10, stop order bulls, they really didn't make money. Limit order bulls, they maybe made money buying below 11, but that's been it today. So it's a lot easier to make money by shorting or just simply being short. 18, we rallied on above the prior bar, inside bar. But 17 was an inside bar, which lowers the probability for breakouts, and 50% chance the first breakout direction fails. So it's a bull breakout, but the bulls still need follow through. And there are sellers into the close of the bar, which is a problem for the bulls. And again, there's no credible major trend reversal setup here. This simply looks like a bear channel. So probably sellers above 18. Maybe buyers below because it's a weak signal bar, but also okay to sell. Betting that we'll end up getting a measured move of this bear flag. Rather than a measured move to the upside, will probably come down here. And again, this measured move, it aligns with the one I have over here, the support. 19 breaking out below 18. So we had this inside bar, breakout attempt failed, reversed down. 19 a stronger bar than 18. Bear bar closing on its low in a bear trend. Reasonable to sell, and you can argue. 3 pushes down. 1, 2, 3. But again, ask yourself how the buying pressure looks, and there's not much of an argument for buying here. 19's a bar bears might take profits on, but that's the only buying that's really taking place. Unlikely the bulls are buying here. They'd rather look to buy lower with more buying pressure, and they're not getting it yet. Minimum follow through for the bears on 20, so breakout 19, follow through 20. Even though it's a doji, the absence of a bull body is the minimum follow through, the minimum requirement. And 20 is a weak stop order signal bar. It's a doji. Again, argue 3 pushes down, breakout of a bear channel. But the channel down is too tight, and the signal bar is bad. Probably sellers above 20. Inside bar 21, micro double bottom, but still bad reversal setup. Tight bear channel, and probably sellers above 21. And then 22 is a variation of an outside bar. It did not quite get above the high of 21, but it did get below the low. So the highs are equal, the low went below. So now we have an outside down bar closing on its low, probably going lower, tight bear channel, nothing to buy. And then 22 or 23, we finally tested this red line, which is down here, the bottom of this third buy climax on the daily chart, which I suspect will be support. Now the problem here, even though this looks reasonable to buy, pretty strong rally, expect a second leg. This is a lot of momentum to the downside, so it's probably not best to just put a limit order down here and to just buy blindly without knowing what the market's doing. And then here's what the market's doing when it gets to that price today. And you have a really tight, strong, small pullback bear trend. And when the market's trending, what did I say earlier? 80% of reversal attempts fail, which means the market is just breaking out below all the support. So even though this is support, just look at 23. We closed right below it. So we might bounce here. There might be profit taking. The bulls might try to get a reversal here, but because it's a small pullback bear trend, most of the support is going to fail to be support. The market's just going to keep breaking out and go lower and lower. So 24, we got buying at that support level. Pretty good bull bar. Enough that the market might start to go a little more sideways. 24 is strong enough for a second leg, but that second leg is minor. So 24 is a leg 1, but it's a minor leg 1, as opposed to over here, bars 4 through 7. That's a leg 1. You could even say all the way from 4 to 10 is a leg 1, but that's major. That's a major leg 1. So more important to get short than here, minor leg 1. Bulls might buy below 24, buy a 50% pullback, look to scalp a second leg up. But you're in a tight, small pullback bear trend, and it's really not worth looking to buy. Better to look to sell. Like you get a bar like 24, the first decent bull bar all day. We know it's likely due to bears taking profits. Better to sell above 24 than look to buy for the second leg. 25 follow through, so breakout and follow through for the bulls. Bad stop order short below 25. Probably buyers below for that second leg, but we're expecting that second leg to be minor. We're expecting this, even leg 1, to be minor. It's probably just a pullback in an overall bear trend. And so if you're counting legs in a trend, you're counting the pullback legs. So like I said over here, it might have been 1, 2, 3, and then continuation. Maybe 1, 2, second leg trap on a smaller time frame in here, which if I remember, I want to go back and look at. We'll look at that in a smaller time frame at the end. 1, 2, and then continuation. In this case, leg 1, expecting at least a second leg, and then probably maybe one more leg, and then probably continuation to the downside. Pause bar 26. It's an inside bar, and it's a trading range bar. so it reduces the probability for breakouts. Sellers above, buyers below. 27 broke out to the downside, but this was enough buying for there to be a second leg. Bears sold a close of 23, trapped on this bull breakout. They're disappointed. Maybe they'll take a 50% pullback. Let's look where that is. But this is another example of minor disappointment. If you sold 23, as long as you don't panic, you're going to make money. Here's 50%. So we're 27 closed at the 50% pullback level of the bull breakout. Maybe we'll bounce here, get a small second leg, maybe go sideways, but the breakout direction still favors the bears. Inside bar, 28, reduces the probability for breakouts, buyers below, sellers above. And then 29, a bull bar testing a little higher, and the danger for the bulls is that the second leg, 1, pullback 2, could just be this one bar. We might go a little higher, but if you're buying, you're really just scalping. And again, I think it's better to look to sell when the market is in this context, small pullback, bear trend. But there's really no major reversal setup here. Again, let's just look at the trend line and ask ourselves if we're getting a major trend line break. And of course we're not. Even if we were, even if this broke out of this trend line and rallied to the moving average, ideally you want to see a breakout far above the moving average, then a retest, and then look for a major reversal. So right now this is all still continuation setup territory, not reversal setup. Probably sellers above 29, and maybe buyers below because it's a bull bar, but the context is bad. And then 30, we reversed down. Traders sold the close of 29. 30 might be continuation to the downside. This might be another bear flag. Maybe we call it a triangle. The market was in breakout mode, but the breakout direction favors the bears. 30 is testing this price level once again, and we might bounce there again. But the reversal attempts are weak, and it's probably just profit taking from the bears. And because it's a small pullback bear trend, we are expecting support to fail today. Small bar on 31, but nothing for the bulls to buy. Maybe they argue breakout, two-legged pullback. They look to buy down here for a second leg, and they can, but I would not. I think it's better to trade with trend when the market is this strong. One more thing about when you just look at the chart today, the market from bar 1 to bar 31, it's clear the market's in a small pullback bear trend. You have hardly any bull bars. It's obviously just grinding lower and lower. And when that's the case, when you have a trending market, I've already talked about this several times, I'm just going to word it a different way. 80% of reversal attempts fail. And so one way to think about that, and this one I got from Brad, you can think of a trending market as sort of a big ship in the ocean, like a big aircraft carrier. And you think about what it takes to stop one of those things. And I don't remember the exact distance he said, and I don't know the fact myself, but the ship needs something like a mile before it can actually slow down and stop. And that's how you can think of trends like this. You need a lot to stop a trend when it's this strong, and this isn't enough. This wasn't enough. And so it's better to trade with the trend and just bet that 80% of reversal attempts will fail. 32 is continuing lower. We're at the low of the day, but it's a bear trend day, so it's reasonable to sell there. Looks like we might be breaking out below this support level. And the bears looking for a double top. Maybe double top, neckline, 23 low, breakout below it, looking for a measured move. 33, we reversed, so the bears got a breakout but no follow through. 33 is a good looking bull bar, so what about buying 33? I would not. I think it's still a minor reversal. Again, we look at the trend line, and we don't have a strong trendline break. This is still a tight bear channel, and so a bar like 33 is probably better to look to sell, especially in a tight channel. But when the market's in a bear channel, the bears are selling rallies, and 33 is a rally. 32 was a bad signal bar for buying, so there were sellers above there, and if you sold above 32, scale in higher, you're probably going to make money. Follow through 34. But a weak bar, it's a trading range bar, testing an area where bulls who bought 29 got trapped. We're testing the close of 29 and finding sellers. And so increased risk, this does not get a second leg up, but instead we just turn back down. This might have been enough for a second leg, but it's similar to here. This was the second leg, just one bar. It's not really worth looking to trade to the upside for a scalp. Better to look to be short, sell for any reason, and hold for a swing. 35, we overlapped 32 by a lot, so it's kind of a tight trading range on the past two bars, but the market's really going sideways in a bear trend. Probably a bear flag. You can call it a low 1. You could call it a low 2, maybe low 1 below 26, low 2 below 35. But if you sell here, stop above 25 or maybe stop above 18, you're probably going to make money, even if you have to scale in higher. 36, bear breakout. Bad stop order, signal bar for the bulls, probably sellers above, probably going at least a little bit lower. And there is no credible bottom yet. If you look at the swing points, really all day, bar 10 was a swing point, a swing low. There was a rally attempt, but it was a weak doji. 23 was a swing point, that's the low. We rallied, but it was a strong bear bar. Same with 32, swing point, but bear bar, bad signal bar. Whenever the swing point bar is counter to the direction of the swing you're looking at, so in this case we're looking at bull reversal attempts, but the swing point bar is a doji or a bear bar, that lowers the probability for the reversal, because most successful reversals have strong signal bars for swing points, or at least signal bars that are in the direction of the reversal. 37, we have a small reversal bar. We're going sideways on this level, the low of the last buy climax on the daily chart, so we can see the market's reacting to this price, but we're not getting these huge rallies off of it. We're really going sideways on it, getting bars above, below, and it's really still a tight channel for the bears. Small pullback trend, bulls still having a hard time making money. If you bought below 24, got triggered over here, you made a scalp, and that's about it. Still easier to make money as a bear. 37, reversal attempt, and maybe it's a head and shoulders bottom, left shoulder, head, right shoulder, but after two consecutive bear bars, fairly weak signal bar, it's small, basically a doji. And what have I been saying about reversal attempts? Head and shoulders bottom, but 80% of bottoms in bear trends fail and become continuation patterns. So I think it's more likely we fall for a measured move of this head and shoulders pattern and come down here. Probably sellers above 37. And then we went outside down 38. Bear bar closing on its low, probably going lower, reasonable to sell. It's a strong signal bar, even though it's at the low of the day, it's a bear trend day. 39, we have a bear breakout, strong bar, not climactic, closing near its low. If a bull bought below 38, betting it's an outside bar and a wedge bottom, they got trapped on 39. They're hoping, let's just get rid of this one now. So maybe 1, 2, 3, outside bar, bulls buy, taking a chance. They get 39, they'll use any rally they can to exit. And then 40, we rallied, fairly deep pullback of this outside bar. But 40 reminds me of 33, where we have a rally, but it's in a bear channel. So this looks like a wedge bottom, and you could even call it a wedge bottom, but you have to understand that 80% of reversal attempts in trends fail. So even though it's a wedge bottom, it's probably going to fail, and more likely we'll get a measured move of this wedge to the downside. This is let me just clean this up. So here's the wedge measured move. Bulls hoping we have a reversal starting with bar 40, but once again, 39 was the swing point. And it was a bear bar, and it was a bad signal bar. There's probably sellers above 39 scaling in higher, and bulls who bought anywhere. If you bought above 37, outside down, you got trapped. That's exactly where bar 40 is testing. So do you really want to buy here, where bulls just got disappointed by these strong bear bars? Probably not. So probably sellers on the close of 40, sellers above 40. We're also approaching the moving average. If we get there, this is a 20 gap bar moving average setup. The market's been below the moving average for over 20 bars. Bears are happy to sell far below the moving average all day. And so if we finally get to the average price, the moving average is one measure of average. If we finally get there, the bears will be happy to sell at the average price. And then you can see traders sold the close of 40, 41 inside bear bar. Inside bar, so maybe reduces the probability for breakouts. But in this context, probably better to sell below 41 than buy below. And of course, probably sellers above. 42, another inside bar, consecutive inside bars. So II pattern, breakout mode. Bulls might argue 3 pushes down, II, buy above 42, look for major reversal. But I'm still bringing up the trend line because there hasn't been a significant trend line break. Here's the bear trend line, and just show me where the bulls have broken out. We're testing it multiple times repeatedly, but we keep failing at it. Here the market's kind of getting squeezed, but I still think when you consider the buying pressure, you consider the fact that we still haven't even touched the moving average today, this wedge might end up getting a downside breakout and a measured move to the downside. 42 II, but probably better to look to sell. It's a tight bear channel, small pullback bear trend. 43 broke out above, but 50% of breakouts fail, so we broke out above, but looks like we failed and might reverse down to the downside. Even though 43 is a doji and a weak sell signal bar, it's always in short, and the upside breakout here, a successful major reversal, is unlikely. Better to be short. 44 bull breakout attempt, breaking out far above, well, fairly far above the trend line, and then above some bars to the left, closing above the moving average. That's good for the bulls. We finally might start having enough of a breakout to constitute a major trend reversal, but we know we're probably going to get a retest of the trend's low. And so 44 also might be a second leg trap. We rallied on 40, pulled back, rallied on 44. And it could also be a nested second leg trap where we rallied from the low of 42 up to 43, pulled back, and then rallied again. And this is the strongest bar, the strongest bull bar all day. The first bar breaking out above the bear trend line and above the moving average. Increased chance this bar fails. Bears might just sell the close because it's a big bull bar. Climactic, opened on its low, closing on its high. First bar above the moving average in a small pullback bear trend. If a bull was long, they'll probably take this bar 44 as a gift, as an opportunity to take profits at a great price. And bears, same logic, they'll look to sell at a great price. 45, we went sideways, so 44, strong bull bar, but if you're a bull and you bought the close, 45 is disappointing. 45, we went sideways, probably sellers above, maybe buyers below for a small second leg, but it's minor. And then 46 could be that second leg for the bulls. 46 is a high one buy setup, but it's a third leg. 1, 2, 3. It's a trading range bar, consecutive trading range bars, possible second leg trap, and best case for the bulls right now, high in a trading range. So not ideal, better to sell above 46. Outside down 47. I said outside bars are expanding triangles. They're trading range bars. That is true, but context always matters. And in this case, we have a bull breakout attempt of maybe the bear trend line, the moving average, but it's still a tight bear channel. And now we have a low 2, micro double top with 45, 47, maybe a double top over here. And you can also call it a wedge, more clear now. 1, 2, 3, outside down 47, probably sellers below. Even though it's an expanding triangle, and in general there's buyers below bars like this, the signal bar also isn't great, and there's probably sellers above if we get there, but I think it's reasonable to sell below. 48, bear breakout. It's a strong bar, and it's not climactic. There's hardly any tails, open near its high, closed near its low. Good for the bears, probably sellers above, probably going lower. Outside up 49, bulls looking for a second leg, maybe leg 1, even though this might already be leg 2, pull back, and then another leg up. But again, best case for the bulls, the market's in a trading range. And we obviously have resistance here. So this might be a high 2, high 1 above 46, high 2 above 49. Good looking signal bar, but context is bad. You're high in a trading range or a bear trend. We rallied a little higher on 50, but we did not break out of this trading range. Plus sellers into the close of 50. Not a very good sell signal bar for the bears. Consecutive bull bars. Might have to get another low 2, second reversal after this. However, because of context, you will have stop order bears selling below bar 50. Probably sellers above as well. Inside bar 51 reduces the probability for breakouts, but we're at resistance in a bear trend or a trading range, best case for the bulls. So sellers above and maybe buyers below for a small second leg, but context is risky. And then bear breakout 52. Now I said with inside bars, 50% of breakouts fail, so it's possible this is one of those 50% that fail and we reverse up. But because of the context, possible wedge bear flag, strong breakout bar, if a bull bought below 51, they're trapped on 52. Just imagine if you bought here and then this is your entry bar. You're probably disappointed, and you might not even take a chance that you'll get out at break even. And we went further on 53, so the bulls further getting trapped. This looks like a fairly strong bear breakout. Might be a leg count reset because we have 3 pushes up, high in a trading range, and now we have a new leg 1 breakout and follow through, crossing the moving average. Reasonable to sell the close of 53, stop above, and expect lower prices. I still have this measured move drawn, the wedge, which you can see led to sideways and about 10 bars and 2 legs, which is your expectation of a wedge, and then probably continuation. 54 going lower, probably still sell the close, leg 1 breakout. 54 is a bad stop order, signal bar, sellers above. Inside bar 55, low 1 and a strong breakout, probably sellers below, sellers above. Then we rallied on 56, but found sellers above, and 56, obviously sellers into the close, bad stop order, signal bar for the bulls. Not great for the bears either, but the context is better for the bears. Still always in short, and probably sellers for any reason. Strong breakout, expect a second leg. Might be sellers on the close of the bar. 57 rallied a little further. Now we have 2 legs up. 56, pullback. 57, could even call it 3 legs. If you look at the tail on 55, 1, 2, 3. Breakout, 3-legged pullback to the moving average. Probably sellers above 57. Buying below, not wise. 58, bear bar, breakout. Closing on its low, good signal bar for the bears, probably sellers below. Bulls disappointed, getting out below. And bears selling to get short. Now we have here's the prior low of the day. We're testing it, so bulls are hoping this is now the bottom of a trading range. And let me see one more time. This price over here, 55.0275. I'm just curious with where the market is in relation to that price. So it's up here. So we're below, above, breaking out below again. And then here, we're at the low of the day. So again, bulls hoping double bottom. The market's gone sideways enough that there could be a major reversal, but there are some things still wrong with this major reversal attempt, like the fact that we haven't gone far above the moving average. The buying pressure isn't great, and you can still argue it's a bear trend, a bear channel. And we didn't get a breakout of a major lower high, and that's a problem for the bulls. So here, yes, we got above this lower high, but you could argue it wasn't major, and so we're just in a bear flag still. Maybe this one was major. You could even argue this one wasn't major, and this was the last major lower high, and we did not get above that. So the market's either in a trading range or a bear channel. So increased risk, we're going lower. More risky to be long. If you're betting on the double bottom with the low of the day, 39.40, strong breakout, probably getting a second leg. Is 58 the second leg? Probably not. Market likes symmetry. So I think at a minimum, probably go for a leg 2 measured move, something like here. And then, of course, 58 is a bad stop order signal bar for the bulls. Probably more sellers above. Breakout to the downside, 59. Not a great bar, but we went fairly far below the low of the day. I had to pause there for a couple of minutes, so I forget where I left off exactly, but bear breakout, consecutive bear bars. And even though the bar closed fairly weak, buyers into the close, it went a fair distance below the prior low of the day. So if a bull was buying the prior low of the day, let's say you were buying right here, this is your entry bar, the bar went far below your entry and even closed below it, so you're probably disappointed. If the market rallies on the next bar or next several bars, probably take that as an opportunity to get out of your losing long, and probably sellers above the bar, even though it's 2 legs down. Bulls might argue overall trading range. They might even argue a bigger wedge. 1, 2, 3. But still bear channel, and this continuation of the trend is stronger than bulls would want. If this was going to be a major reversal where we ended up going sideways for about 20 bars, you want the retest of the trend's extreme to be a lot weaker than this. In this case, you got a 5-bar micro channel, pretty strong bear breakout, and then a fairly strong breakout to a new low. And then look at bar 60. You can see, let me get rid of this. You can see we're going closer to that leg too. I was just saying that this probably was not the second leg down after this. And then look at bar 60. If you bought the low, I'll just extend this for a second. Here's the low. If you bought, got trapped on 59, 60 rallied, would let you out at your entry. And that's what happened. The market rallied to that price. Bulls who bought, disappointed, they exited their longs. Bears who doubted the breakout, they see that it actually might succeed. They end up selling that pullback of the breakout point. So 60 rallies to that price, reverses down. So low 1, fairly strong breakout, probably sellers below, sellers above. And then 61, we went a little bit lower, but fair amount of overlap. Not ideal, but still nothing for the bulls to buy, because this entire breakout, this entire channel, 2 legs down, is tight enough that it's probably a breakout on a higher time frame. If you think about the 15-minute chart again, here down to 54, these 3 bars, that's a strong bear bar. Then here is another bear bar. So from 55 to 57, we rallied, but we didn't get above here, so no pullback. And then obviously continuation. And so this is all a breakout. So maybe a low 1, consecutive dojis. There was buying here. The bulls hope for buying here. But the reality, there's not a lot of buying pressure through here. We're probably going lower, tight bear channel, overall small pullback bear trend. Bull bar, so there's a bounce there. Bears probably taking profits, but it's probably minor disappointment from the bears. If a bear sold the low tick of 59 and then we rallied up to 60, yeah, they might be disappointed and we might bounce like we did. But this is a weak reversal setup, probably sellers above 62, and then 63 instead of going above, just sold off. Now 63, fairly climactic bar. Bear bar closing on its low. Looks like one of the biggest bars we've had all day. and it's up there with the biggest bars. We're probably going lower, and this is strong enough that it's probably a breakout on a higher time frame. And we know just by inferring what the 15-minute chart looks like that it is in fact a breakout on a higher time frame. So maybe a parabolic wedge, 1, 2, 3, 63, breaking out of a channel line. A little climactic, there might be some buying, but again, there's really nothing to buy. And if you're a bull, you're on the sidelines waiting. And if you're a bear, reasonable to take profits on 63, but also reasonable to hold some of your position short for a swing, like maybe for this measured move target. Follow through 64. So bulls buying the close of 63, hoping it's acceleration and climactic and a wedge. They're disappointed with their entry bar. 63 is a breakout, 64 is follow through, even though there's a fair amount of overlap. Maybe a low one short, maybe buyers below 64, but if there are, it's really minor and it's too tight to look to buy. Better to look to sell. Sellers above. And then we fell a little further on 65, but pulled back. But 65 is like 55, where you have a bear breakout and then a weak signal bar, so probably sellers above. This entire sell-off is a micro channel. There's been no pullbacks from 58 to 65. That also increases the chances of sellers above. But then you just look at the bar itself, trading range bar, buy reversal bar, but bear body, and the context is bad to buy, sellers above. 66 rallied, bull bar, but bears sell rallies in strong trends. This is a strong bear trend, and 66 is a bar. It's really just from bears taking profits. Bulls are not eagerly buying here, and so 66 might be enough for a small second leg, and that's probably the best the bulls get here. Maybe buyers below the bar, but bears probably selling here, selling above, and scaling in higher. And then we traded above 66, but went outside down. Outside bar, trading range bar, and I said there might be buyers below 66 because 66 was a low one signal bar after maybe a late sell-off, 3 pushes down, overall late in a bear trend, lots of bars. So we might start to go sideways, and 66 was a weak low one signal bar, bull trend bar. So there's probably buyers below it, but best case for the bulls is a minor second leg, still always in short, sellers above 67. 68, we're going a little more sideways to down. Micro double bottom, 65, 68, but bad signal bar. Most reversal attempts fail, sellers above 68. 69 inside bar, so reduces the probability for breakouts. Buyers below, sellers above. However, in this context, if you're buying, you're scalping, and you're taking a chance because there's not a lot of good buying pressure through here. Outside down 70. And outside bars are trading range bars. Now maybe it's 3 pushes, 1, 2, 3. The third push is an outside bar. But the market's constantly creating wedge bottoms in bear trends. Also, I didn't mention we're at the measured move target here on 65, and so that contributes to the more sideways price action we're getting here. This measured move target being reached, we're getting some profit taking from the bears, but the buying pressure still isn't good enough to buy. So nothing really to buy. Sellers above 70, maybe buyers below for a scalp if the bulls are lucky. Inside bar 71. IOI pattern, breakout mode, sellers above, buyers below, but still always in short. Probably looks like a bear flag here. 72, we broke out to the downside. Bears still want follow through. 72 broke out to a new low, but there still needs to be confirmation. Sellers above, maybe buyers below scaling in, but not ideal because that's counter trend. And then a big bull bar, 73. So no follow through for the bears. Market might be converting into a trading range here. Lots of overlapping bars late in a trend, but still not getting bars above the moving average. 73, the bulls are hoping for follow through, and really a bar similar to 73 on 74 would be ideal. A big bull bar closing up here. making this big down, big up overall trading range. But for now, we're still below the major lower high somewhere up here, and this is still a bear trend. And if you have a rally in a bear trend, bears will sell. But 73 is strong enough for a second leg up. You can argue 73 is a second leg. We rallied on 71, deep pullback, rallied on 73, or even over here, one consecutive, or maybe consecutive sell climaxes, complex, three-legged pullback, deep pullback, one, pullback, two. But either way, resistance in this area. But not ideal to sell below 74 when 73 was as strong as it was. But 73 is really a buy vacuum test of resistance. And if the market's in a trading range here, maybe expanding triangle, breakout mode, it's more common to see bad signal bars work, like a bar like 74, especially in this context. Outside down 75, bulls got their second leg. We rallied on 73, pause, rallied on 75, and then reversed down. Bear bar closing on its low, and probably sellers below, at least probably going to test a new low. But this might be enough sideways that there's buyers below. $76 falling a little further, bad buy signal bar, sellers above, probably going to test a little lower, and then a big breakout on 77, but that is definitely the biggest bar of the day, almost 20 points, clearly bigger than all the bars late in a bear trend. This is sort of a gift. This is a bar that is a profit maximizing bar. Bears see this bar and they'll take it as a gift, and they say, wow, that's a windfall of profits late in the day, late in a bear trend. If you're still short, probably best to take profits on a bar like 77. It's really aggressive to use that logic to then buy the close of a bar like 77. However, I think it is more likely 77 is exhaustion and will probably go above the bar before we go for a measured move of the bar. 78 bad follow through, so big down, big up. Probably an exhaustive sell climax, probably going to start to go more sideways. Only a couple bars left in the day, and probably going to go more sideways. And then some follow through for the bulls, but inside the big bear bar. Big down, big up, big confusion, probably sellers above, buyers below. 80, we rallied a little higher. We might go a little bit higher, but there's probably resistance above. And then 81 tested above the big bear bar, the exhaustive sell climax. So the logic there, you get a bar like 77, you buy the close, stop down here, and then you bet we're going to close the exhaustion gap. Because it's so late in the day, really not ideal to take that trade. You'd have to be holding into the very close of the day. Ali recommends you stop trading by about bar 72. And the reason for that is if you had 72 chances to make money all day and you couldn't or didn't or whatever it is, it's probably just best to leave it alone at the end of the day. When you can get lower probability events, the market is creating the close of the close of the bar on the daily chart. You can get more extreme volatile moves, and it's still tradable, but and the price action obviously still behaves as it always does, but probably best to just leave it. And so here's the day on the daily chart, and for always in today, pretty simple, big gap down, the market accepted the gap, bar 1 and 2, always in short, and it just really never became always in long today. For limit order trades, sellers above 2, sellers above 3. Micro channel, sellers above the first pullback, bar 10. Sellers above 12, outside up, 3 pushes up in a bear flag. At this point, bear breakout, becoming a small pullback bear trend, sellers above any bar. 24, not ideal to sell above, probably get a second leg, but then 28, inside bar, expect breakouts to fail, and if you're selling above it, you're betting on a second leg to fail, so reasonable to sell above 28. I just realized I usually start with stop orders, so let me back up. Stop orders today, I thought it was okay to sell below 1. However, usually best to wait for maybe about 6 bars before taking any trades to get a little more information. especially when most days our trading range opens. Outside down 4, you could sell below 5, sell the close in here, sell below 6 or 7. Better to sell the close 6, sell below 7. You could sell below 9. 3 pushes down, but minor reversal expected. Sell below 13, low 2 in a bear trend. When the market's always in short, you can sell below any bear bar, closing below its midpoint. So that applies to all through here. And then maybe a 3 push pattern up to 47 you could sell below, but outside bar probably going to get retested. 51 you could sell below, but use a wide stop because it's a small inside bar. Stop above 51 is a skunk stop. Better to sell a bar like 52, 53, 58, low 1 you could sell below. 63 you can sell. 64 you can sell below. There's breakout and then follow through. Sell below 75, high in this trading range or bear flag, outside down, expecting at least a test of the new low. And then, I don't know, maybe you can buy above 78, but again, just late in the day, not ideal. And then limit orders, I already said a few, and then up through maybe where to get to here. Tight bear channel, 3 consecutive bear bars, probably sellers above 32, betting the double bottom will fail. Same with 39. But then here, 3 pushes, you're going to probably get 10 bars and 2 legs. Not ideal to sell above these bars. But over here, 49 is a high 1 or a high 2. Here's a good high 1 to sell above. 46, high 2, 49, sellers above. High in a trading range or bear channel. Strong enough breakout here, sellers above 55, 56. Micro channel all the way down, sellers above 65. Bad buy above 69, sellers above. Bad buy above 72, sellers above. Breakout, but bad follow through, possible second leg trap. Rally, high in a trading range or bear flag. You could sell above 74, the disappointment bar. And then you could buy below 77. Probably better to buy below 77 than sell below. And let me just go back quickly. I wanted to look at bar 18. I thought it was probably a second leg trap on a lower time frame. Let's look at 11 a.m. on the 1 minute chart. So here was that. Let me just pull it up on the 5 minute too. Going 11 a.m. So this bar right here is bar 18. I was saying it looks like a leg 2 trap over here, where there's a small leg here, pullback, second leg trap, a bigger climactic second leg, overall in a trading range, rallied pretty high in the range, but overall bear trend. And that's what we're seeing right here. So here's a strong enough rally for a second leg. It's a minor leg 1, but you're probably going to get a second leg, nested wedges. 1, 2, 3, maybe a double bottom, failed breakout below. Here's a double bottom with 1018, 1040, and then a breakout below. So whenever you have a breakout below a double bottom, that's a wedge. So wedge bottom, strong enough bull bar, 1050 for a second leg, but they'll probably buy a pullback. They bought the pullback and then rallied for a second leg, but looks like a second leg trap. High in a trading range, big climactic rally that obviously failed, led to lower prices. So I just thought that was interesting. And as always, if anybody has any questions, please feel free to leave them in the comments for me. Include timestamps for any question specific to this video. And I hope everybody has a good rest of their night. Thanks for watching.